Hi, I'm James Robinson, and this is my stock thought of the week. So, as the world continues to battle COVID-19, and I think that the market is overpriced, and I'm not going to give any stock tips. So, what I'm going to do is I'm going to continue my series on value investing theory and what you should be thinking about if you want to be a value investor, at least the way I understand it. So, this is part two. So today we're going to talk about what is a stock, both the definition, the way a value investor looks at it, and the way I think you as an investor should consider to look at a stock. And it's going to be a little bit different maybe than what you've been taught or what you think you understand about stocks. So the formal definition of a stock is the stock of a corporation is all of the shares into which the ownership of the corporation is divided. Shares are a very small portion of a corporation, which gives you a small ownership of the company. In American English, the shares are collectively known as stock. So effectively, imagine that you have a big company, say Cisco. They may divide themselves up into, 1,000,000,000 shares. And so if you buy one share of Cisco, you would own 1/1,000,000,000th of the company. And in theory, you'd be entitled to 1/1,000,000,000th of the assets and 1/1,000,000,000th of the profits. Those profits typically are paid to you as dividends. So that's the formal understanding of what a stock actually is if you asked a finance professor. Now let's juxtapose that to what the average American, the average investor somewhere around the world thinks about a stock. And this is sort of the people who are aware that there is something called the Wall Street Journal, and they're aware there is something called the stock market. And they don't really understand how it works. They don't really understand what's going on, but they see that, there's CNBC and financial news. Their friends tell them about companies they should buy, et cetera, et cetera. So for the average investor, I really believe that a stock is a number associated with a symbol. So for example, IBM. So it's the number $112 a share and then the name of the company. Most people understand that dollar value could go up or down. They don't really understand why it goes up or down, what causes it to go up or down. They don't really understand what fundamentally is behind the price. They're aware the company may or may not pay a dividend. They're not sure where that comes from or what that means. They just know that if they buy this stock, they might get a tiny little check every quarter, which check they probably aren't putting very strategically into their analysis of the company. Effectively, it's this sort of amorphous blob of value that no one really understands what's going on, but they're aware that really smart people on Wall Street probably have some clue. So from the layman's point of view, or let's say maybe the view of an investor who is not a pure value investor, their reasons to buy a stock are pretty varied. They'll buy a stock because a friend told me to, so they got a tip. They'll buy a stock because they perceive everyone else is buying it. So Tesla's a really hot company. I don't want to miss out. I don't want to get left behind, so I better buy some. They'll buy a stock because it recently went up. They'll buy a stock because it recently went down. They'll buy a stock because they like the products. They'll buy a stock because they saw the chart, right? And there's something called a technical trader who doesn't necessarily need to know anything about the company. He just looks at the chart and the shapes that the stock is doing. And then, again, from my point of view, looks at that and says, oh, well, there's like a shaman looking at chicken bones and deciding what's going to happen with the value of the company. But the point here is that a layman's logic is there's no system. It's not very well thought out. They haven't really come down and tried to understand what a stock is and what's going on with the company. They're just playing a game. It's a giant casino in some regards. So that's the way a layman looks at stock. So I play a lot of poker, and the same kind of thing that happens at the poker table seems to happen in investing. In poker, if you really understand the game and you understand the math and you understand the probability, you're probably going to win money against the layman because you just understand more fundamentally what's going on. And the same is true with stocks. And so I'm reminded of a famous stock quote by a guy named Big Julie Weintraub. This is probably back in the 40s or 50s. And he says, the guy who invented poker was bright, but the guy who invented the chip was a genius. And the idea here is that somehow the casinos and the card rooms have figured out a way to divorce the process of gambling from the concept of money. If you were putting a $100 bill on the table every time you played a hand of blackjack, I think it'd be harder to do that. I think it'd be harder to continue to gamble that money. But because you're just putting these black chips on the table and these chips are supposed to be for gambling, at some point they sort of lose their value and they just become chips. And you get a bunch of chips, you lose a bunch of chips, but it doesn't feel the same thing as losing money. And I think the same thing is true of the stock market. If you're just buying shares in a company, if you're buying stock and you're just buying shares, somehow it doesn't feel the same thing as if you're investing in a company, in the whole company. So the concept I'd like you to consider as you're thinking about being a value investor is that chips are not cash, and as a result, people behave differently than if it was. And so that same logic is stocks to the average investor are not companies, and so they behave different than if they were buying whole companies. So now let's juxtapose all that with the value investor. The very first concept that I think you have to understand about value investing is that when you are a value investor, you are not buying stock. That is not what you're investing in. That's not what you're looking at. You're not looking for stocks that are cheap, because you don't know what cheap means yet, right? So you're going to divorce yourself from this idea that I am buying stock or a stock or shares. Instead of looking at every stock purchase as if you were buying stock, look at every stock purchase as if you were buying the whole company. You see, when you're buying stock, you say, well, a share costs $69 a share. And that doesn't mean very much, other than it used to be $55 a share, or it used to be $70 a share, and now it's changed, and now it's, for some reason, a good buy. But if you're buying the entire company, then that will give you clarity. You'll say, well, okay, if I was buying this company, how would I value this company? What would I think this company is worth? What are the things that makes this company a worthwhile investment? Now, I want you to look at this idea that we're buying an entire company from two different points of view. From the point of view of an investor, if you were looking at buying the entire company, would you really care what a sliver of the company sold for? That will divorce you from the concept that a share of the stock is going for a certain price. You want to just get over that. You wouldn't care what the sliver would sell for. You wouldn't care what the sliver sold for last week or last month, and you wouldn't care if a buddy suggested you should pay for that sliver. What you're saying, what you'd be looking at is, yeah, that's all a waste of time. What's the company worth? Right? What is the company actually worth? And then I'll work backwards and figure out how much of that company I'd like to buy. This is a great exercise to help you think through what you should be doing when you buy a company. Instead of saying I'm going to buy stock in Apple, or I'm going to buy stock in IBM or whatever company you're interested in, I want you to imagine that the company isn't a public company. The company is owned by your brother-in-law. And you're not really sure about your brother-in-law. He might be a genius. He also might be a buffoon. He also might be a con man. You don't know. But what you know about your brother-in-law for sure is that he's just asked your parents to invest their entire net worth into his new company. And that your parents have come to you and said, we don't know what to do. This might be the greatest opportunity of our lives, but it's also very scary, because we're just not sure if we can trust this guy to know what he's doing. If that scenario was presented to you, you would not say, what did the stock trade for last week? You wouldn't say, what was the tip? You wouldn't say, what the technical chart for the company is doing. If it was your parents' money, you would do some homework, right? So what homework would you do? Well, you'd first of all try and find out what kind of business it is. What's going on with it? What are the prospects in that industry? What's going on? What are the obstacles to that industry, and what are the benefits of that industry? You would certainly ask, what are the company's profits, and what are those profits have been over some significant period of time in the past? You would say, how are the company's finances, right? Does it have debt? How much debt? What's the interest rate? Does it have the ability to pay that debt? What are the terms of that debt? You would care about that on behalf of your parents. You would ask about the manager. You'd want to find out, does this company run by your brother-in-law, or does he have somebody running it for him? And if he's got somebody running it for him, you'd like to understand something about that manager. You'd want to know, if you're investing the money, how are you going to get your money back? Is he going to buy you out in a year? Is he going to buy you out in 5 years? Are you going to try and hold the company forever and make dividends and let the asset appreciate? Or is this the thing where you're going to invest your money for a few months and get your money back? You'd want to try and decide what you would pay for the company if you were buying the entire company. You'd want to know what the risks are, and you'd want to know if you could liquidate it to get your parents' money back. So those are the kinds of things that you would ask if you were protecting your parents. And if you really think about it, if you're willing to ask those questions protecting your parents before you allow them to make a big investment, why wouldn't you ask the same kinds of questions about the companies that you're looking to invest in? And that's all value investing is. You come up with a way of figuring out what a company is worth, and that really is a discounted cash flow of some kind relative to the company's earning power, and or a analysis of the company's assets and net worth. and you say, okay, this is what I think this company is worth, independent of the stock price, independent of the market cap. You understand what the company is worth, and then you start figuring, okay, well, if that's what the company's worth, how much would it cost me to buy it? What are the shares worth? And hopefully, when you find that the value of the company is higher than the value that you're paying for the collective value of the shares, the market cap, then you figure that company is undervalued. As a value investor, we're always trying to look at it like our brother-in-law is trying to sell us shares in this company. And it may be a fantastic opportunity, and it may be a complete nightmare. And we're trying to figure out what that is. So the kinds of things that we're looking at as a value investor that are the same, but maybe moderately different than the brother-in-law analysis, we're looking for an income stream that can be identified, it can be quantified, and it can be understood and predicted, hopefully. It's predictable, I should say, hopefully. That income stream is the significant portion of where the value of the business comes in. You could argue that a business's value is its discounted cash flows into the future of those future income streams. And so you want to know what those are, and you want to be able to predict them with a high degree of certainty. If you can't predict them with certainty, then you're really hoping things will work out. And a value investor doesn't want to spend a lot of time hoping. Once you know what that is, then you can calculate the intrinsic value of the company. There's really two ways to do that. Again, this discounted cash flow model, or you can figure out the total value of the assets minus the total value of the debts. But again, in today's day and age, there aren't a lot of opportunities to buy companies where the asset value is directly in proportion to the stock price. You then, once you know the intrinsic value of the company, and we're going to talk a lot about intrinsic value in future videos, but once you know the intrinsic value, then you're trying to buy it for some number below the intrinsic value that provides you a margin of safety in case you've miscalculated or bad things happen. So to a large extent, as a value investor, our investments are driven by profits. So that gives you a sense of what a stock is to me, a value investor. It's not a symbol and some numbers associated with it. And it's not something my buddy told me to buy, which is why I almost never listen to tips. To me, it's an entire company that I have been given the opportunity to buy a tiny slice of. But first I have to figure out what the company's worth. Then I figure out what I'd be willing to pay for that slice. And then I decide, okay, if this is what I want to pay for the slice, what's the market want for that slice? And if there's an imbalance there in my favor, then that's when I buy it. So thank you very much for your time. If you want to follow me on Twitter, my handle is @robinsonstocks.com. I'll post articles there occasionally when I buy new stocks. You'll see it there first. Oftentimes it takes me time between the day I buy a stock and the time that I make a video about what I bought or what I sold. So thank you in advance for your time.